Now, the PBOC put limits on silver exports, which are still in effect in mainland China. These four LPMCL clearing members can still access offshore CNH future silver from the international hubs on the Shanghai Gold Exchange that face west, but the bullion is also being bid on competitively to meet other global shortages, which makes supply even tighter. Since everyone wants silver, these inadequate LPMCL shipments from the US and China may have temporarily eased the debt burden. However, the best way for these silver cartel members to avoid failure is for them to buy back large amounts of unallocated silver with physical at higher market prices. People who have bet on silver futures on the COMEX, LBMA, and OCC are being protected at all costs. This includes very big short stops that have just started to be hit above. These stops, now the higher up you go, the more likely it is that these stops will catch fire, which will lead to a disconnect between the spot silver standards and the rest of the world. We looked at the very short term in our last episode and the ones before that. While we expect 53 to be the next rally staging post, liquidity providers think that $140 silver would be the most likely staging point to bring enough bullion to market, which is needed for the short covering to be completed. We were looking at futures, but in the real spot market, which is driven by every other currency, FX currency and silver making all-time highs, we have seen silver test the 53S and mid-53S. This disconnect is caused by this EFP spread, which we're going to talk about in more detail. Allow me to show you a quick example of silver trading in the SGEI exchange, which is the overseas Chinese exchange. While I'm at it, let me also show you some gold. There has been an unprecedented full-spectrum backwardation into as deep as July 2028. It's so crazy you have to see it to believe it, and things have gotten a little better since then, but this market is still broken. As we said before, these kinds of backwardations didn't happen during the Hunt Brothers short squeeze in 1979 and 1980. During that time, the backwardations were able to be contained and cash circles inside the siloed COMEX, which is where the market was. Now, the Western-facing SGEI physical exchanges are affecting every other silver and gold foreign exchange cross, and as we already knew, the quarterly OCC reports from the Office of the Comptroller list the historically accrued unallocated unbacked foreign exchange silver derivative bets being handled for the Fed by the two remaining official banks, JP Morgan and Citi. Remember that we showed the unwinding of the 5-year derivative bets in the third quarter? That was an important point to keep in mind. But out of the 4 LPMCL members, ICBC, Standard Bank, JP Morgan, and UBS, basically JP Morgan is the only one who gives you access to OCC derivative bets. The other 3 are ICBC, Standard Bank, UBS, and JP Morgan. Interestingly, and not by chance, last week's hastily put together suggested OCC rule change was a rule change that got missed. Now the CME has finally raised their gold and silver margins from 17,000 to 18,000 and from 16,500 to 17,500. Since last Friday, the London Open lease rates for borrowing silver to meet immediate delivery demand went through the roof, jumping way above 24%. We're using 24%, but it was actually over 30%, which is what caused the silver short squid EFP basis spreads that we just talked about. We caught it live at a huge $2.80, which is $14,000 per contract. It has been as high as $3,500 per contract. Now the expanded base spread loses the spot equivalent fix. To show this, we spot adjust it in and show it in green during fix hours. As you can see, it is much higher than the COMEX, where we actually replaced the spot equivalent COMEX fix. At the peak, we recorded these never-before-seen backwardations of the future that went all the way through July 2028. This is so crazy that it's never been seen before. It shows that COMEX silver market futures are completely broken. The market is broken, but we can see that the SGE-centered, physically slight global spot markets are shaking this COMEX tail in real time. I just find it amazing that so few people have noticed this big COMEX break. In fact, the SGEI silver prices consistently set local London spot prices that are exactly the same as the new highs in both spot silver and gold. In short, London's silver cupboards are completely empty because of unprecedented supply constraints caused by hoarding and strategic positioning around critical minerals that led to global export controls. Now, what's even worse is that they have undeliverable local London FX obligations that have been hedging these COMEX short positions. This means that when they're asked to physically deliver these bets in London, they can't cover into globally driven higher physical price demand. This has shown these LBMA CME derivative bets to be unfairly mismatched. These bets are now being called in, which means that default is possible if they aren't brought back at higher prices, which further reduces the supply. There are now physical shortages around the world that have affected all global exchanges. For example, India's Kotak Mahindra stopped ETF investments, citing a lack of supply at current prices. Since then, UTI, SBI mutual funds and other funds have stopped new subscriptions to their silver ETF funds, so you can't get to them. London has lost control of the global silver market, as we said before. It's now so clear that it's hard to ignore the historically high risk of unfulfilled local London lease fees. These spreads could be closed at any time, and while registered COMEX inventories seem to be in enough supply to meet a rush of delivery demands, these leveraged CME warehouse receipts are unfairly hedged against an unfactored lack of local London supply. This is why US lower-priced US-denominated bullion is slow to be shipped out to take advantage of up to a hugely attractive $15,000 per contract. Silver should have been flown out last week, last Thursday, last Friday. 160 SI lots would equal 25 tons. You could put those in on a plane for a matter of a few extra cents per ounce, yet it was very slow to move, and this is really what we're drawing attention to. And while we're evidencing some profiting from shipping US bars to London, and we'll look at why this will not lower the higher spot price to meet the lower futures price, in fact, quite the opposite is going to happen. So minor short-term volatility aside, it's the record high global spot prices in every single other foreign exchange currency, no matter which one you look at across the board. Spot silver is at record highs, unlike protected or capped US-centric futures silver. It's so obvious, it's a mind-boggling that and yet we look at them history to Main Street. I'm on Bloomberg all the time while they are caught onto gold. They have no idea that the silver market's broken and how undervalued dollar silver is, and that reflects what it is doing is reflecting really the supply shortages, with this effect forcing the US silver prices much higher. The US is the sole outlier and is being targeted, and while the LBMA clearing members are facing default and are really racing to fly out what little silver bullion they can from the COMEX registered and eligible stocks into London, this is largely serving to satisfy immediate unallocated over-the-counter bets that have been called for delivery into empty local London vaults. It's just really trying to keep pace with an immediate default, notably illustrating it takes higher prices to bring silver to market. So what's in? It's evident this basis EFP spread and lease costs, they expand significantly into lower prices. They contract into higher prices, but literally expand significantly into lower prices. Nobody wants to lease this out. And while inbound US silver shipments are serving to relieve some of the EFP basis spreads between the COMEX futures and spot currently still averaging a deeply backward, I'm looking at it right now, and the dollar spread is still $5,000. We've seen it go up about 77 cents, but today it's down $60, so there's still plenty of time to ship out silver to meet this demand. It doesn't take long to put 25 tons on a cargo flight. As for global physical shortages, they'll quickly absorb anything that arrives in London. In fact, while shipments are protecting against an immediate default, the only way to fix the problem is to bring more bull into the market, but it would have to be at higher prices because it won't be offered otherwise.